So overall, today was pretty uneventful, although there were some big headlines that come out, and we're going to talk about all that today. First being that the U.S. and Vietnam have decided to finally make a deal. So they struck a trade deal that will see American goods entering Vietnam duty-free. And in return, the U.S. will charge a 20% tariff on Vietnamese goods instead of a 46% tariff rate that was announced during that April Liberation Day announcement, all before that 90-day pause began. And then they got that, they walked back tariff rates back to that 10%. So it seems that we're double the 10%, but we're less than the 46%. So it all sounds good, right? Also note that goods that pass through Vietnam from other countries to the U.S. will be charged 40%. Think like China, for example. These are what's called these transshipment of goods, just so that they don't go through Vietnam to avoid other country tariff rates. And this makes trade deal number 2 after the UK deal. So we got 2 whole deals. Vietnam is the 8th largest trading partner for the U.S. with nearly $150 billion in two-way trade in goods in 2024. And it does account for the United States' 3rd largest trade deficit, which was more than $123 billion last year. And this news comes right after Trump said that Japan's a tough one, that they likely won't secure a deal with the U.S. at least anytime soon. So we'll keep on watching all of this and seeing what happens. Now, as far as what Trump had to say on it, he started off with this big announcement. Hey, we struck a deal, details to come. And then here's the deal. He kind of outlined some of those terms we just talked about. And so that's where we're at regarding this. We're not going to read this entire thing. We just kind of talked about it, but Trump is truthing about it. Also, he's also back to back with Jerome Powell. Too late, should resign immediately. And he shares this article talking about how Jerome Powell should be investigated for this $2.5 billion remodel that's going on. I don't know that that's any good, but while we're talking about the Fed says they're more worried about inflation rather than the labor market. And we got some job data in today that this one was probably the news of the day. So we got ADP employment data today. And right here, let's leave it right here. What we've seen is that, and what ADP measures is the private sector payrolls, and it's more so for smaller companies and doesn't have quite the data that goes into the employment report that we'll get tomorrow. But some people watch this, some people disregard it. And what we've seen is that jobs reduced in June. For the first time in more than over 2 years, overall payrolls slumped this 33,000 job figure you see right here versus the gain of 90,000 something jobs that was expected. So, I mean, the expectations were all over the place, right? There's these ranges. Some people think here, some people think here. Let's say 90 to 99,000 is where a lot of them are running. So let's just even round up to 100,000. We're expecting a gain of 100,000. We got a decrease of 33,000 jobs. So that was a huge miss, but layoffs are still rare. So let's just throw that as a cherry on top. So some dismiss these ADP numbers just because it's seen as not reliable and a lot smaller than the data we get from the BLS, which they configure into their reads. And usually the two don't move the same. I remember there was a recent report in an ADP miss, and then the BLS figures that came out the next day, like, they were actually good. So the scare that was caused by these ADP numbers were just blown off. So it's caused a lot of people to ignore it. But it's hard to ignore such a surprising miss, and some say that the Fed was expecting to see this based on Jerome Powell's comments at the European Central Bank Summit or Forum. I don't remember which one it was. But he was just talking and he was asked, and this stuck out to a lot of people when he said that, hey, I don't know when we're going to cut rates. It depends on the data, but I wouldn't take any meeting off of the table at this point. And some are saying he's seen these numbers early, and that's why. Now, let's look at what the CME Fed Watch thinks for July's meeting. So we're back over 20%, up to 25%. Still, I mean, it's pretty low. I'd imagine these numbers are set pretty much in stone unless we get another huge miss on tomorrow's employment report. And gosh, that would be crazy if we did. So we could possibly see a cut in July, assuming those numbers come in as a miss. But remember, there's a range. Now, for September, let's see where we're at. 70% for the cut. I kind of feel like this fell down a little bit, didn't it? All right, well, anyways, all of that aside, the real tell will come from that employment report that comes out tomorrow that everybody is waiting on. Literally everybody is waiting on this. Economists, company CEOs and CFOs and investors themselves and the talking heads on CNBC, everybody's waiting on this one. So this report is coming out tomorrow, and there's expectations anywhere from this 110,000 figure all the way up to the, let's say, 115, 120. Either way, that is down from the prior month of 139,000 jobs being added. And like I said, if this comes in super weak, it may have to cause the Fed to give in to actually cutting rates at July's meeting, as we were just talking about. This year through March, the U.S. has added an average of 124,000 jobs a month, which was down from last year's of 168,000. So it seems like there's a common trend here, a broad slowdown. And like layoffs aren't too crazy, right? They're not like all over the place, but we did get a huge announcement today from Microsoft. And what Microsoft was announcing is that they're going to be laying off 9,000 workers. And this is after them laying off around 6,000 back in May. So Microsoft's like quietly laying people off, and we're just watching this. And there's other signs or red flags showing up. Who knows if it's all related or not, but let's just click this button right here. Boom. Del Monte Foods, tons of articles. What are they talking about? Bankruptcy news. Del Monte Foods announces entering Chapter 11 bankruptcy and is looking for a buyer after tariff pressure has pushed this company against the wall and to look elsewhere as far as business ventures. So I don't know if all of this is just kind of like into the same basket or if it's completely unrelated. But we're seeing cracks in the economy, and like, yeah, you could blow off this ADP number. Oh, yeah, it's not a big deal. The data's rigged. Small data. This doesn't really mean anything. And then Microsoft announcing layoffs. Big deal. That's just one company. And then a company announcing Chapter 11 bankruptcy and looking for somebody to bail them out. It's just all a coincidence, right? Now, despite all of this going on, stocks have reached a fresh record today with the S&P 500 reaching a new high, the NASDAQ leading the way. Why don't we have both charts up? Let's look at both. No, let's look at 4 charts. Let's look at that. Let's look at the NASDAQ. Let's look at BTC USD. And let's also look at the VIX. I want to see if the VIX is doing anything. So, all right, a whole lot of green today, which is interesting. And look at this. I think this is interesting. Look, on the 50-day moving average, both the S&P 500 is above, NASDAQ is above. They just keep on bouncing off of it. And we had that golden cross happen, which is super bullish for stocks. We've talked about it. Bitcoin is under that, and it seems like the 50-day moving average and the 200-day moving average are coming back to a point to where they could possibly cross paths again, and that would be a very bearish sign. Yeah, we've seen the VIX really spike today. I'd imagine this was when the ADP employment numbers came off, and then there wasn't a big scare in the stock market, and then everybody just kind of calmed down. Oh, just breathe, y'all. This isn't the report we're waiting on. This is just more data to add into our theses. Now, there are still bullish articles out there. So we got this one that's by Mark Holbert. There's a 68% chance that stocks will rise by year end. Do you feel lucky? Do you want to be a millionaire? U.S. stocks are likely to be higher on December 31st, and it has nothing to do with politics or the economy. So they go on and kind of talk about this 2 out of 3 chance that the stock market will be higher. Some may decide that a 1 out of 3 chance of losing money is too high for them, especially if like you're closer into retirement, you don't got decades to park some money and wait. Like if there was a crash and wait for it to come back and come back higher, you got to retire soon and live off of that money. So then they just kind of go on and talk about it, and they go on to say that the standard response from financial planners to these statistics is that you can reduce your risk of loss, which is what people don't like that 1 in 3 chance of losing money this year is too much for them. So they could reduce their risk of loss if you hold equities for a much longer period than just tomorrow or 5 days or 6 months. And it is true that the odds of losing go down as your holding period goes up. Based on the history of the U.S. equity market, you never have lost money had you held for a minimum of a couple decades and reinvested dividends along. There's a catch, however, 2 catches. The first is that there is no assurance that the future will be as good for the U.S. stock market as it's been for the past 2 centuries. A lot of people say we've been spoiled over the years. And when extrapolating, hopefully that's how you say that word, the country's stock market history into the future, you implicitly are assuming the fate will continue to smile on U.S. equities, which have continued to shine. That's a big assumption, they say, almost all of which have lagged the United States significant margin when you compare to other countries' stock markets. We shouldn't overlook that several countries whose stock markets collapsed at different points over the past century and investors lost everything. And we shouldn't forget Japan, whose stock market plunged in 1989 and didn't rise above that year's peak for more than 3 decades. But Japan's known for not having really any inflation, which that's a different story here. The second catch is in otherwise assuming that the long term will bail you out is inflation, provided, oh wow, it's like it read my mind. We were just talking about inflation. Provided you're measuring performance in nominal terms, your odds of making money go way up when you hold for a long term. This tendency is significantly lessened when you focus on inflation adjusted returns, which is important when focusing on the long term, over which inflation can take a huge bite out of those returns. So yeah, it's great. I made 100% this year, but inflation was 105%. So were you really winning, or are you losing pace compared to, you're losing purchasing power compared to inflation? So that's kind of that second catch. Stocks for the very long term. One way of illustrating the importance of focusing on real rather than nominal terms is to calculate how often stocks beat bonds, since their initial yields when buying and holding are correlated with inflation. Because when inflation expectations go up, there's that, hey, like that opportunity cost. Investors are weighing what to do with their money. Should I lend it to the government and get this guaranteed rate of return? Or do I expect inflation is going to like do this and be much higher than the rate this is paying, so I might lose money, versus this company might benefit from inflation and my money might do better here? So then like they peep that over here and they're like, oh, well, nobody wants to lend us any money over here at the government for our bonds, so we got to raise our rates. So just such a calculation was conducted by Edward McQuire, a professor, yada, yada, yada. The chart below shows the percentage of time since 1794 in which U.S. stocks have beaten U.S. bonds as a function of holding period. The long term won't necessarily bail you out. No matter how much you expand the holding period, the percentage of time stocks have beaten bonds never rises above 68%. Coincidentally, this is the same percentage as in the chart above that applies to whether 6-month holding periods produce a nominal gain. The bottom line here, and honestly, never rises above 68%. And we're at 68%, so that's like a high. So like, give me that is what this article is pretty much saying from Mark, Mr. Mark, I think was his name. Hopefully I didn't forget that quick. Yeah, Mr. Mark. So the takeaway, the bottom line, how you react to this data depends on whether you see the glass half full or half empty. The half full narrative celebrates that despite all of this risk and despite high valuations, narratives focuses instead of the 1 out of 3 chance of losing money, either in nominal terms over the short term or in real terms relative to bonds over the long term. Either way, There's no escaping risk. Now, gains are always great, but what's better? What's better than just gains in the stock market? Beating the stock market. So more people are always wanting to beat the stock market, these boring index funds, and get phenomenal gains. They want to get rich tomorrow so they could screenshot these huge, phenomenal 1,000,000% gains on these trades so they could share it to the Wall Street Bets Reddit page. And with the development of AI, a lot of people are beginning to try to use and hope that they could use this AI to help beat the market rather than just buying these boring low-cost index funds that, like, my grandpa told me to do that. I don't really want to do that. But it's almost like they're right in a way because it hasn't widely been able to do that yet. And that's what this article is talking about. And it kind of goes on to talk about, yeah, we're super early and maybe that'll be the case one day. But we're just not there yet as far as how good this technology is just yet. So we'll keep on watching this. I'm not going to say that AI is not going to get to the point to where it can outperform the stock market. But once that begins to happen on a larger scale, because I'm not going to say it's not happening for anybody out there. You know, there's probably somebody in there like killing it and they're just keeping quiet. Because once the word gets out, and AI is able to outperform these funds, and then everybody starts relying on AI to outperform these funds, then that kind of takes the opportunity out of stock markets, and then it becomes more, what's that saying? Based on what you believe, like you believe either all of the news is available and the stock market reflects all the news available, or it doesn't react as quickly, so there are opportunities because of that. Whenever AI is completely relied upon in the stock market, there won't be any inefficiencies. Like everything will be priced in immediately. So I don't know if that's a good thing or a bad thing. But markets love these all-time highs. But it's what's happening beneath that matters more, especially as we got these ADP numbers coming in and this job markets numbers and everybody weighing on whether or not the Fed will cut rates. So rate cuts may sound bullish, but they're often a sign that something is breaking, something's brewing that's not good. And as AI, trade shifts, and corporate belt tightening pick up speed, this calm might be the setup, not the payoff. So y'all, thanks for hanging out with me. Hope you enjoyed this video. I'll be back tomorrow. We got a huge one coming. See you there.